topic is the basic principles of covered call writing. We'll also show you a real-life trade that I made using many of the principles that I'll be discussing this morning. And we also have Barry Bergman with us, who is the BCI Director of Research. And feel free to type in any questions as we go along, and Barry will answer them for you in real time. And if at the end of the presentation, if we still have some time left, we'll be happy to take additional questions. Now, covered call writing is a low-risk option selling strategy geared really to retail investors. And I'm highlighting the word selling because that implies that we're going to be generating a cash flow into our brokerage accounts, and that is precisely what covered call writing does for us. So in today's presentation, we're going to go through the 3 required skills that will allow us to achieve the highest returns with this strategy, and those are stock selection, option selection, and position management. Now, to get started, I know many of you probably are not that familiar with the strategy, or perhaps just barely familiar with it. So I'm going to give you a hypothetical preview example just to give you a little background. Then we'll get into the meat and potatoes of the strategy. And after this, all the trades that you're going to see, all the charts and calculations, are trades that I've actually executed in my brokerage account. So in this preview example, we're first going to purchase 100 shares of stock. It could be any stock. We'll just call it company XYZ. And let's assume we pay $48 per share, so our investment or cost basis is then $4,800. Now, once we own these shares and we are in a covered or protected position, we are now free to sell the option. So buy the stock first, then sell the option. Now, what we're doing here is we are selling some unknown person, because everything is done online with the tap of the computer, the right but not the obligation to buy our shares from us at a price that we determine, by a date that we determine, and in return for undertaking this obligation, we are paid a cash premium that's determined by the market. Now, in this hypothetical, we're going to buy the shares for $48 and agree to sell them for $50 at any time over the next 1 month. I predominantly sell 1-month options because that's the time frame where I've had the greatest amount of financial success. So almost all the trades you're going to see today are 1-month trades. Now, we're going to be paid a premium for undertaking this obligation, and a typical premium in a scenario like this would be about $1.50 per share, or $150 for the 100 shares, less a small trading commission. Now, this would represent $150 on a cost basis of $4,800, a 3.1% 1-month return. Now, if we could do that every month, it would annualize out to 37%. Now, at the end of the 1 month, there are 2 possible major outcomes. In the first scenario, let's assume for a moment that the price of the stock remains under the $50 agreed upon sales price. Well, the option buyer is not going to elect to exercise the option and buy our shares from us for $50 if, let's say, the price of the stock remains stagnant at $48. So the option expires worthless. We keep the $150 no matter what. Now, let me put that out there right now. That $150 is ours to keep once we click the computer to sell that option. So that means we've generated a 3.1% 1-month return. We still own the shares, and now we're free to sell another option the next month. The second possible major outcome, we're going to assume the price of the stock does pop through the $50 agreed upon sales price. Let's say it goes up to $52, and we take no action. We'll talk about that later. If we take no action and the price of the stock is $52 as the contract expires, the option holder is going to exercise that option, buy our shares from us at $50, turn around and sell them at market for $52, and that person is going to generate a profit. However, we're the option sellers now. So let's have a look at this trade now through our eyes. We generated $150 on the sale of the option. I told you that's ours to keep no matter what. Now we've generated an additional $200 on the sale of the stock. Buy at 48, sell at 50 times 100. That represents a 1-month profit of $350. On a cost basis of $4,800 represents a 7.3% 1-month return. Now, if we could do that every month, it annualizes out to that ridiculous number you see at the bottom of the screen, 87%. So let me stop now and state the obvious. You are not going to get this type of return on every position in your portfolio every month of the year. However, in normal market conditions, and particularly in bull market conditions, you will see some of these every single month, and we have to know how to take advantage of normal and bull market conditions. Now, whatever strategy we're using, we have to be able to talk the talk. So there's a few definitions that we have to know before we use this strategy. There's not a lot, but I'm going to go through a few of them now, and then you'll hear me repeat them over and over again as we go through today's webinar. First, let's start with the very basics. What is an option? Well, it's a contract that allows the holder or buyer of that option the right but not the obligation to buy or sell 100 shares of stock, or it could be an exchange-traded fund, at a fixed price known as the strike price, and that was $50 in our preview example, by a specified date known as the expiration date. And I told you that I sell basically 1-month options. Most options expire on the 3rd Friday of the month, 4 p.m. Eastern Time. Now, a call option, which is what we're going to be dealing with in today's webinar, gives the holder the right to buy 100 shares of stock at the strike price by the expiration date. A put option is the opposite. It gives the holder the right to sell 100 shares of stock at the strike price by the expiration date. We will not be dealing with put options in today's presentation. 3 more definitions. We're going to talk about the option strike price. Again, that's the price we're agreeing to sell our shares for, and as it relates to the current market value of the stock. The first definition is at the money. At the money means that the price we're agreeing to sell our shares for is the same as the current market value of the stock. Example, we buy a stock for $50 and agree to sell it for $50. Yes, folks, we actually do get paid for that. And that's called an at-the-money strike. An in-the-money strike is the one that's the most difficult for most people to understand. And if you could learn in-the-money strikes and how and when to utilize them, it will make you an elite covered call writer. An in-the-money strike is where you agree to sell your shares for a price that's lower than the current market value of the stock. Example, you buy a stock for $56 and agree to sell it for $50. Well, why the heck would you do that? The answer is the premium that you're going to generate from the sale of that option is going to compensate you for that $6 difference plus a little bit more. And it's that little bit more that represents your actual initial profit. And I'm going to break that down for you in the next slide. The third of these 3 definitions is known as out of the money, and that is by far the most popular strike price used by covered call writers. And it's the one that I used in the preview example, where we bought a stock for 48 and agreed to sell it for 50. Now, the reason this is such a popular strike price is that it allows the trader the opportunity to generate 2 income streams in the same month with the same cash, with the same stock. One from the sale of the option and the other from share appreciation up to the strike price. That's exactly what I showed you in the preview example. We generated $150 on the sale of the option and $200 more on share appreciation from 48 to 50. And that's why out of the money strikes is used by 95 to 99% of all covered call writers. But there are times and circumstances where you should favor the in the money strike, and I'm going to be addressing that in today's webinar. Now we have two more definitions here. Option value, that's the premium we generate as it relates to the current market value of the stock. Now if you look at the bottom of the screenshot, you see an equation that all option traders need to know and understand. And that is the premium that we generate from the sale of the option consists of intrinsic value plus time value. Now don't get intimidated by these definitions. As we go along in today's webinar, I'm going to break it down for you with some real life examples, and it will all make sense. Intrinsic value applies only to in the money strikes, and it's the amount that the strike price is lower than the current market value of the stock. The example I gave you before was we bought a stock for 56 and sold the $50 call option strike price. Now, if we generated a premium of $8 on the sale of that option, that $8 would be broken down as follows. $6 is intrinsic value. That's the amount that the $50 strike price is lower than the current market value of 56. We cannot count that as profit, because if we bought a stock at 56 and sold it at 50, we're losing $6 on the sale of the stock. So the only component of the premium when we sell an in-the-money strike is the time value, which is everything above the intrinsic value. So premium of 8 equals 6 plus 2. $6 is not profit, $2 is profit. So when you sell an in-the-money strike, if you want to figure out your actual profit, you have to deduct the intrinsic value from the premium. Now, while I'm giving you all this math, which may weigh heavy on you, let me give you some really good news. At the end of the presentation today, I'm going to tell you how you can all get a free copy of the basic Ellman calculator where all this math will be done for you. All you have to do is put in the price of the stock, the strike price, and the premium, and it'll break it down for you as you're going to be seeing over and over again during the webinar today. So that's at the end of the presentation. I'll tell you how you can all get a free copy of it. So I don't want you to be concerned one bit about the mathematics of this. So just to review now, selling covered call options is buying stocks and selling call options on a share-for-share basis. In order to sell one contract, you must first own 100 shares of stock or exchange-traded fund. To sell 5 contracts, you must first own 500 shares. So, if you owned 199 shares of IBM, you can only sell one options contract and still be covered or protected. Therefore, when we buy shares for purposes of covered call writing, we always buy them in 100 share increments. Now, whatever strategy you're using, whether it's covered call writing, put selling, whatever you determine is right for you and your family, you should have some very good reasons why you're using that strategy. And the reason should not be that I said so, or some screaming guy on TV said so, or some newsletter told you to. It should be because you've educated yourself, you've done your due diligence, and you've made an informed, non-emotional decision based on sound fundamental, technical, and common sense principles that this is the right strategy for you and your family. After all, we all work very, very hard for our money, and we want to make sure that when we invest it, it's the best opportunity to retain the capital and to develop income, passive income, based on that capital. Now, here are the reasons why I use covered call writing as my go-to strategy in the stock portion of my portfolio. And you could see on the screen there are 9 reasons. I'm going to discuss the ones that I highlighted. There are 4 that I highlighted. I'll talk about those. The others you could simply read off the screen. And number one, probably the most important, is that of all the low-risk strategies that I have tried, covered call writing is the one that I've had the greatest success with and been able to generate the highest returns. And that, of course, is why I am inclined to use this strategy over all other stock and option strategies. Number 4 on the list is very important to me as well, because when you use covered call writing, in essence, you're in two positions. You're long the stock, which means you own the stock, and you're short the option, which means you've sold the option. Now, when the trade turns against us, or turns out to be way better than we thought, or there are dividend concerns, or expiration Friday concerns, there's so much that we could do to manage those trades. There are a myriad of exit strategies that I've developed and that are in my books and DVDs, and some of which I will share with you today, that will allow you to either mitigate losses, turn losses into gains, or enhance gains to even higher levels. So it's critical, and that's the third skill I mentioned early, position management, in addition to stock selection and option selection. The third highlighted reason why I use covered call writing is that you can compound your money instantly. Here's what I mean by that. When you buy the shares and then sell the option and you click the computer to execute that trade of the option sale, that cash is generated into your account instantly. Now, I'm going to use a big number here, but it's for purposes of explaining what I mean. Let's say you have an account of $300,000 that you've dedicated to covered call writing. And let's say, I'm going to give you an average amount now, you generate $10,000 a month selling options on those shares. What you could do is you could take that $10,000 in cash, purchase new shares with it, and then instantly sell call options on those newly acquired shares, thereby compounding your money in minutes. I know of no other strategy that allows you to do that. The final highlighted reason, also I believe very important, is that our government considers this strategy low risk enough and appropriate to be used in our self-directed IRA accounts. Now, when we sell options, we're going to be generating cash into our account every month, and those are short-term capital gains. So if we could trade in a sheltered account, we will not have Uncle Sam in as our partner. And again, this is the one option strategy that universally across the board with every brokerage allows you to use it in a self-directed IRA account. Now, folks, I would be remiss if I painted this strategy as a panacea with no downside risk. There's no strategy out there. Let me just repeat this. There is no strategy out there where you can get a higher than risk-free return that involves no risk, at least none that are legal. So I always include this screenshot in my presentations so that you can make an informed decision as to whether or not this is the right strategy for you and your family. Okay, so let's start with number one, which is basically stating the obvious, that if the stock price declines below the break-even, you could start to lose money. Let's go back for a moment to our preview example. If you recall, we bought the stock at 48 and we sold the $50 strike price for $1.50. Well, our break-even there is $46.50, 48 minus 150. If the price of the stock after we enter the trade starts declining below $46.50, we start losing money. Now, your next door neighbor who just bought the stock and didn't sell the option starts losing money the moment the price of the stock drops below 48. So you do have a little downside protection in a bearish market with covered call writing. However, you can lose money on the stock side. Now, that's where our exit strategies will kick in. And again, I'll be able to share with you a couple of them in today's presentation, but this is a skill that you must master to achieve the highest returns. Number two, folks, is the main disadvantage of covered call writing. So please focus in on this one. Your profit potential is limited by the strike price. Now, here's what I mean by that. And let's again go back to our preview example. We buy the stock 48, sell the 50 call, boom, we have $150 into our account. Now, a week later, let's say there's some kind of news announcement. The FDA approves a drug manufactured by that company, and the price of the stock goes to the moon. It's $60 in 1 week. Now, we've agreed to sell these shares for 50, and we'd love to get our hands on those additional 10 points, but we cannot because of our option obligation. So the takeaway here is, with covered call writing, we could generate a steady cash flow every month, but we are never going to hit a grand slam home run. We are never going to make thousands and thousands of dollars on one trade unless we're using a very large number of options contracts. So as I say here, don't get greedy. In that preview example, we generated 7% in 1 month. That's pretty darn good. But we have to go in with the understanding that if some unexpected good news comes out about the company, that our profit potential is limited by the strike price. Now, the last two are less of a disadvantage, but I just wanted to be thorough with this slide. And there's what's called assignment risk. That means that when we sell an option for the holder to buy our shares, that may in fact happen. Our shares may be sold. Now, the way I do covered call writing, I could care less because my portfolio is constantly turning over. But some of you out there might want to write calls on a long-term buy and hold portfolio just to increase your annual returns. And there's a specific way of doing that, a little bit different than the way I'm describing in this webinar, more traditional covered call writing. But we know when those options are going to be exercised and our shares sold 99% of the time. And that is the day after expiration Friday. The Saturday after expiration Friday. If the price of the stock is higher than the strike price we sold, even by 1 penny, your shares will be sold on that Saturday. It won't be in your brokerage account. And all this newly found cash will be. But since we know the time, 4 p.m. Eastern time, and the day, the third Friday of the month, when our shares will be sold, we could take action and avoid that by buying back the option, which is one of the exit strategies that I'll be discussing at the end of the presentation today. However, there is and are some rare exceptions to that, and that is usually related to a dividend distribution. So if there's a dividend that's going to be distributed before expiration of the contract, there are times when our shares will be sold early. Now for me, again, I could care less. That means I've maxed my trade, I have my cash back early, and I could put it to use, maybe earn some more money on that same cash. However, there are those of you out there, and with good reason perhaps, that want to hold on to your shares, generate the dividend. So there are very specific ways of dealing with that and avoiding early exercise. Again, that's in my material, which I'll be showing you later on in the webinar. And finally, and this probably applies to all strategies, there's a learning curve and a time commitment, but not that much. Okay, most new investors to covered call writing need about 3 to 4 months to master the strategy where they should feel comfortable investing their hard-earned money. As far as the time commitment is concerned, I spend about 3 to 5 hours a month generating way more than a half a day's pay. So once you master the strategy, although there is a time commitment, it will not be egregious. And you can, even if you're working a 9 to 5, you'll be able to handle this strategy. Okay, so at this point in time, we're going to get into stock selection. And basically, there's a 3-pronged approach to stock selection. I'm going to go through all 3 prongs with you in general terms, and then again, to get into more detail, that's in my material that I'll mention later. Fundamental analysis, technical analysis, and what I call common sense principles are the three-pronged approach to stock selection. What I want to tell you is you never want to select a stock based on the option return. That's a major, major mistake. What you want to do is develop a watch list of elite performing stocks from a fundamental perspective, which is sales and earnings, from a technical perspective, reading a price chart, and from a common sense perspective, and I'm going to go over all 5 of those principles in just a moment. Now, fundamental analysis, I use 3 screens. Feel free to use whatever screens you would like, but if you're a member of the Blue Collar Investor, these are the screens we use for our premium members when creating the watch list for eligible covered call writing candidates. And 2 of them are Investor Business Daily screens. The first one is called the IBD 50, which basically are growth stocks with great chart technicals. I have had just a huge, huge amount of success using the IBD 50 screen. But it's only 50 stocks. It used to be 100. They streamlined it down to 50. So you have to go to other resources. And one other resource, it's not on the screen here, but let me just mention it, is finviz.com. They have a wonderful free stock screener, and you can put in certain fundamental parameters, and it will develop a list of great fundamentally sound stocks, and then you can move on with your screens from there. But I use the IBD 50, plus the Blue Collar Investor has developed a database of over 3,000 securities that we have identified over the years as potential covered call writing candidates. So for our members, we screen the IBD 50 every week, plus that database of over 3,000 stocks. But you don't have to become a member. You can do it on your own, and I explain how to do that in my books and DVDs. The second screen is the IBD Smart Select. That basically is a screen that screens not only the stock, but the industry that the stock is in from both a technical and fundamental perspective. And it gives you numbers and letters, but adjacent to those numbers and letters are what's called the checklist, which are 6 circles next to each category. And the elite performers are colored in green, mid-level yellow, and the underperformers red. We require all 6 circles to be green. So again, we have elite performers from both the fundamental and technical perspective for both the stock and its industry. Finally, the MSN Scouter rating, which is not available to the public currently. It will be soon, but we are managing to get these rankings for our members. It's a ranking system based on 10 years of historical data, and they've identified certain traits in stocks that will allow us to project certain stock winners over the next 6 months, so stocks that will be more likely to outperform the S&P 500 over the next 6 months and with the least amount of volatility. So they created certain equations and then developed it into a ranking system of 1 to 10. We require a Scouter rating of 5 or higher in our screening process. Now, before we get into a bit of technical analysis, let me tell you about the 5 common sense principles that we use in our screening process. And the most important one is the one right at the top. And this is worthy of writing down if you're thinking of using this strategy. Never ever sell an option if there's an upcoming earnings report prior to expiration of the contract. There's way, way too much risk in an earnings report. It may miss what's known as market consensus, or what the analysts are projecting for sales and earnings. Even if it misses by a penny, the price of the stock can get killed. Also, there's the whisper number, which are what the Wall Street insiders are predicting. May be different than consensus. It may miss that, and the price of the stock can go way down. And finally, it usually provides guidance, and if the guidance is negative, even though the report was wonderful, again, the shares can be hit hard. So I never sell a call option if there's an upcoming earnings report, which then, if you could take it a step further, tells you that I never use a stock for more than 2 months at a time in my covered call portfolio because most companies report quarterly. Now, along those same lines, there are a group of stocks that report same-store retail sales on a monthly rather than a quarterly basis. Years ago, there were about 80 companies. Now they're down to about 8 to 10. And these reports act almost like earnings reports, where if, let's say Walmart reports bad same-store retail sales, boom, the price can get hit, even if it's not an earnings report. So those stocks are what I call banned, B-A-N-N-E-D, banned from consideration 100% of the time as it relates to covered call writing. We recently added all 13 of the airline stocks to this list of banned securities because they report monthly capacity reports, which lets people know the percentage of seats sold. And again, analysts project these numbers, and if they disappoint, the stock can get hit. So all in all, between same-store retail sales and airline stocks, there are about 25 stocks that are banned. And once again, at the end of the presentation, I'll let you all know how you can get a free copy of that file as well. I just keep it right next to my computer, so if I have any question whether there's a banned stock that I'm looking at, I just take a look at that list and just cross it off. We require a minimum trading volume of 250,000 shares per day, and no one stock or industry should represent more than 20% of your portfolio. And finally, we should try to allocate a similar amount of cash to each of our positions. It'll never be exact. For example, if you have a stock that's $115 a share and another one that's $15 a share, it doesn't make sense to have an equal number of each of those securities. The way I do it is I decide how much I'm going to allocate to each position. Let's say you have a $50,000 portfolio and you project 5 stocks. So that means you're going to allocate $10,000, about $10,000 per position. What you do is take the price per share, divide it into 10,000, and you'll get a number. Let's say the number's 333, and then move it down or up to the nearest 100. So 333 would be moved down to 300. You're going to buy 300 shares of that stock and sell 3 options contracts. And that's how you'll be able to allocate a similar amount of cash to each position. Okay, so again, just to review now, we're looking at stock selection and we're basing it on 3 prongs: fundamental analysis, which we've talked about, common sense analysis, which was our last screenshot, and now technical analysis, reading a price chart. I'm sure many of you out there already know how to read a price chart. Some of you do not. Do not be intimidated by this. It's very, very simple. Once you've set up the parameters you're going to use, and you use those very same parameters for every stock you're evaluating, you'll be able to read a price chart in less than 3 seconds. Now, I'm happy to share with you folks the parameters that I use and I've had a lot of success with as it relates to covered call writing. But feel free to use whatever parameters or indicators you're comfortable with. But I believe it should have a trend identifying parameter. I use moving averages, 1 or 2 momentum indicators, and I use the MACD histogram and the stochastic oscillator. And I believe that you should be able to take a look at volume so you can confirm the other indicators or look for divergence, and you'll see in the next chart. So those are the parameters that I use. If you've never heard of these before, don't get intimidated by them. You do not have to be Albert Einstein to read a price chart. Now, here's a typical price chart showing those parameters that I just mentioned. So let me just break it down for you without getting into too much detail. Technical analysis is a very large portion of all my books and DVDs because I believe it's so important to be able to read a price chart. But you'll be able to see from this example that it's really not that complicated. So So let's start at the top. At the top, you see a blue and a red line. Now, the blue line represents a moving average, a 20-day moving average, and the red line is a 100-day moving average. Now, these moving averages are known as exponential moving averages, which means the more recent prices are considered more heavily when figuring out the moving average. If it was a simple moving average, every price point would be of equal weight. So when we're selling a 1-month option, we want to see quicker changes, and that's why I use the exponential moving averages, and people call that the EMA. Now, the 20-day EMA is the blue line. The 100-day EMA is the red line. If shorter-term prices, we want higher than the longer-term prices. It makes sense, right? We want to see an upward trend. So here's what we're looking for on the top, folks. You let me know if you think we need Albert Einstein on the phone now. We want to see these trending up. Yep, trending up. We want to see the shorter-term blue line higher than the longer-term red line. Check that. And we want to see these price bars at or above the short-term EMA. Check that. So we have a bullish moving average indicator on the top. So far, so good. The trend is our friend. Now, what about the momentum on this stock? Now, without getting into the calculations or the equations for these, and it's really not even important to know that, the MACD histogram are these blue bars in the middle of the screen. The MACD itself is the black line. So we want the MACD and the histogram to be above zero. You could see that it is. We also want it to be ascending. Now you could see these blue bars are above zero, but they're beginning to decline, right? And the black line, the MACD, is above zero. So we have a mixed MACD picture. Bullish moving average, mixed MACD. Next, the stochastic oscillator. We also want that ascending, moving up. Well, look, folks, it's moving down here on the right side of the screen. So we have a bearish stochastic oscillator. Let's summarize so far. Bullish over here, mixed over here, bearish over here. What about volume, the volume bars at the bottom? Well, we can see that volume is beginning to decline. Now, if we looked at the moving average here as a rocket ship heading to the moon, then the volume is the fuel supporting that rocket ship. And that rocket ship may be running out of fuel. This is called negative volume divergence. It's a red flag. There's no indicator that we're going to hang our hat on and make a decision based on just that one thing. No way. Okay? It's a mosaic. It's a picture we're painting. So what is this picture telling us? Well, it's telling us that we have a mixed technical chart. Mixed. So what does that mean? Big deal. Well, what that tells me and tells us is that if we're going to use this stock for writing covered calls, we should probably not take the most aggressive covered call position. We might want to take one a little more conservative. And as you're going to see shortly, that means we may want to sell an in-the-money strike as opposed to an out-of-the-money strike. And as you'll see, in-the-money strikes give us an insurance policy on the time value profit of our option sale. So all this kind of works together. So again, when you're reading a technical chart, it could be all bullish, it could be all bearish, in which case we wouldn't even consider it, or it could be mixed, as you see here, in which case that might dictate the type of strike price that we select. Now, here's an example of creating that watch list. This is the report, part of the report that we provide to our premium members. And what I want to show you here is this top blue bar, thick blue bar towards the top of the report, and those are basically the screens that I talked to you about so far. Fundamental analysis, common sense principles like 250,000 shares per day, and then technical analysis, as you see here, EMA, MACD, stochastic oscillator. Okay? Now that would eventually lead us to our watch list, which we call our running list. And we call it a running list because it's constantly changing. We update this for our members every week. And once again, if you're a member of the Blue Collar Investor, we create these lists for you, but in my material, I will explain how to do it on your own. So if you're inclined not to become a member, you still can do this on your own. Now, our watch list includes much more than just listing the stock. We give earnings report dates, industry name and rank, dividend information, etc. And you can see here also, if there's an earnings report that month, we highlight that row in gold so our members can't miss it. So where are we so far? Well, what we've done so far is we've created an elite watch list for covered call writing based on sound fundamental, technical, and common sense principles. But we haven't made any money yet. So I think, folks, it's time to make some money. So to do that, we have to access an options chain. An options chain is just a list of options prices for a specific security, stock or ETF. And whatever broker you're using is going to have this information, but there are free sites like finance.yahoo where you can access this information as well. Just put in the ticker symbol of the stock and then look for the options link. And here is a typical options chain. Let me just go through some of the points on this options chain to familiarize you with it. On the top right, circled in red, is the price of Nuance Communications at the time that I made this screenshot, 2407. Column 1 are the strike prices. Those are the prices we can agree to sell our shares for. I highlighted in the green row the $25 out of the money strike, higher than the current market value. Column 2 is the ticker symbol of the option, which contains the ticker symbol of the stock, the expiration date, the strike price, and the little C in the middle, which you may and may not be able to see, means call option. Column 3 at the end tells you about how many contracts of this option are open, and we require a minimum of 100. Here you can see over 12,000. And the most important columns here are in the middle, the bid and the ask. I highlighted the bid because that's the price we're going to sell our option for. If we bought an option, we'd be buying at the ask. Later on, I'm going to tell you how to negotiate as a retail investor, how to negotiate a better price with the market maker. But we're going to show you the worst case scenario, the bid column. So if we sold this option for $75 for the 100 shares on a cost basis of 2407, that means we've generated a 3% initial 1-month return. Now, is it not true, folks, that if the price of the stock goes from 2407 up to the 25 strike, have we not generated an additional $93? Yes, we have. That's an additional 4%. So in this case, we have an opportunity for a 7% 1-month return. Let's get to that negotiating with the market maker. There is an SEC rule known as the show or fill rule. What that says is the market maker must either execute a trade that improves the market, and improving the market simply means putting in an order between the bid and the ask, or he must publish that trade. So what we do is, let's say the spread is $2.50 to $3. That's a big spread. I try to negotiate if anything is larger than 10 cents. Here's how I do it. I find the midpoint of the spread, in this case, 275. That's known as the mark. And I drop down a little bit in favor of the market maker. So in this case, I would enter a limit order of $2.70 when I sell that option. Now, the market maker is either going to say, okay, let me get rid of this guy Ellman quickly and give him his 270, or he's going to have to immediately publish the new spread at 250 to 270. Now, these guys are making money by selling low and buying low and selling high, and they make their money on the spread. So they want to keep the spread as wide as possible. So to get rid of us in our few contracts, frequently we will get executed at this higher amount. And believe me, over the month and years and decades of trading, this will amount to a significant amount of cash in our accounts. Okay, I want to remind you now that the profit is time value divided by your cost basis. The calculator will do this for you, but if we sell an in-the-money strike, we must deduct the intrinsic value. Now, I've been showing this screenshot for years and years and years. It's a very, very old options chain for Apple before it went to 700 and split 7 for 1. At the time, it was trading at 205.93. Now, the reason I show it, folks, is that if you look at the second column from the left, that's the symbol. The symbol doesn't make any sense compared to the one I showed you before. That's the old option symbology. So quickly, if you ever buy a book on options that was written before 2010, like my first two, for example, you're going to see these unusual option symbols. That's the reason I show this screenshot. But just to take it home now, I highlighted the 210 out of the money strike, which generated $815 per contract, which represented a 4% initial return. Now, if the price of Apple goes to 210, we generate another $407, another 2%. So we have an opportunity in this case for a 6% 1-month return. Here's an options chain for a more recent options situation, Synaptics at 57.36. And we're going to look at the 55 in the money strike and the $60 out of the money strike. The bid prices were $490 and $240. You could see open interest was well over 100 contracts. Let's now see the Ellman calculator in action. Now on the top two rows, we've entered the $490 and $240 for the $55 and $60 strike. So basically in the calculator, you're filling in the blue columns and then the white columns become populated. You won't see yellow, purple, and pink. I did that just for highlighting for this webinar. All right, in the money 55 strike, let's break this down now. This is important. Intrinsic value of $232. That means that the 55 strike is $2.32 in the money from the current market value of $57.32. The calculator will deduct that from the $490, telling us that we have generated a real-time value profit of 4.7%. Now, what if Sina goes up higher? Too bad. We are limited by the strike price. It can go to 100. We're still only going to be able to sell at 55. No opportunity for upside potential. However, we have downside protection in the form of intrinsic value. In other words, our 4.7% is guaranteed as long as share value does not decline from 57.32 to below 55. That's 4% downside protection. That's not break even, folks. That's guaranteed a profit of 4.7% as long as share value does not decline by more than 4% by expiration Friday. I would use this strike price with a chart like you saw before with mixed technicals, or if our overall market assessment is bearish or volatile like it is right now. Now, what if we were bullish on the stock and the overall market? How about the 60 strike? Well, here we have no intrinsic value, of course, but we have an opportunity for another 268 on share appreciation from 57.32 up to the 60 strike. So we have an initial return of 4.2% with a possibility of another 4.7% or total of 8.9%. Now, here's a strategy I use in my mother's portfolio where I sell covered calls on exchange-traded funds. Now, these are mutual funds that behave like stocks, and many of them do have options associated with them. Here I'm showing you a screenshot for the Qs, which represent the 100 largest non-financial companies that trade on the NASDAQ exchange, so mostly tech companies. At the time, the security was trading at 88.73. We're looking at the 89 call, slightly out of the money, for $1.16. Feed it into the Ellman calculator, and you could see here that we have a 1.3% 1-month return, possibility of another 0.3%. The price of the security goes from 88.73 up to the 89 strike. So we have an opportunity here for 1.6% 1-month return, which would annualize out to 19%. Not so bad. Now, one thing about ETFs, they require less management. like we don't have to worry about earnings reports. But generally speaking, they're less volatile securities than individual stocks, and therefore the premiums of ETFs, generally speaking, are going to be lower than those of individual stocks. Now, managing our covered call positions doesn't start after we enter the trade. It starts before we enter the trade, and we've talked about this. Stock selection, which involved fundamental analysis, technical analysis, common sense considerations like earnings reports, trading volume, and then strike price selection, which I'm going to address again now, just to kind of summarize what we've said so far, and then we'll go over a couple of exit strategies. Time permits, I'll show you a real-life trade. See, we have about 22 minutes left. In the money strikes, the example I gave was you buy a stock for 56 and agree to sell it for 50. Well, this is the most conservative of all the covered call writing positions to take. We use this when chart technicals are mixed or your overall market assessment is bearish or volatile. If you could learn how and when to use an in-the-money strike, you will be so far ahead of almost all other covered call writers you wouldn't believe. At the money strikes, the example we gave was you buy a stock for 50 and agree to sell it for 50. It's a bullish position. We use it when chart technicals are good and market conditions are positive. This is the strike price that you'll be able to generate the highest initial return, but have no opportunity for upside potential or downside protection of the profit. There will always be a break even, which is share price minus total premium. Out of the money strike, the most popular of all the strike prices, it's the most bullish covered call writing position to take. We use this when you're bullish on both the stock and the overall market. That's the one, folks, where we generate two income streams in the same month with the same cash with the same stock. All right, let's have a look at this options chain on a stock trading at 37.03. We're going to look at the 35 in the money, 37.50 slightly out of the money, and the $40 way out of the money. Feed it into the Ellman calculator. Now, if we were bearish on the stock, on the market, and chart technicals were mixed, how about that 35 in the money strike in green, where we generate a 1-month return of 2.3% and an insurance policy on that profit of 5.5%. That means the stock can go down from 37.03 all the way down to 35, and we still will have generated a 2.3% 1-month return. Well, what if we're bullish? How about the 37.50 slightly out of the money strike? We generate an initial return of 3.9% and an opportunity of another 1.3%. The price of the stock goes up to the 37.50 strike. Here we would generate a 5.2% 1-month return. Now, as we get into exit strategies, we've entered the trade. What can happen? What could possibly happen to the price of our stock? 5 things. Let's keep it simple, because it is simple. The price could go up a lot. We win. We make our option profit plus any share appreciation from the strike price, from the share price up to the strike price. Price can go up a little. We win. Got our option profit plus whatever share appreciation from the purchase price in between and up to the strike price. Price could stay the same. We win. We've generated our option profit. We still own the shares, and now we're free to sell another option. The price can go down a little. We probably win. We've generated our option profit, let's say 3%. Now, if the price of the stock goes down only 1 to 2%, that means we've still generated a profit of 1 to 2% in that 1 month. Now, here's the one I need you to focus on the most. The price can go down a lot and we could lose, and that's where our exit strategies come into play. Excuse me. Get some water here. Okay. In my material, I break down position management into 2 time frames, the first half of the contract and the second half of the contract. All exit strategies begin the same way. You buy back the option. When you buy back the option, folks, it cancels out. So covered call writing is buy a stock, sell an option. If you buy back that option, you just own the stock with no obligation whatsoever, but it puts you in a position to either take no action, sell a different option, sell the stock. There are a lot of different ways you can go. Now, here you see the strategies that I discuss in my material. We're going to go through one I call hitting a double, and you could tell I'm a baseball fan, and I named this because it was intuitive to me way back when I started doing this on my own before I even thought about the blue-collar investor. And so here's how this works. You sell an option. STO means sell to open. I sold this at 410. This is a real-life trade. Despite all the screening and everything, price goes down in the first week. And that was brought down by overall market. Wasn't news about the stock. So I have what I call a 20%, 10% guideline that's in my material where I explain when to buy back that option. And 20% in the first half of the contract is 82 cents. But it's a guideline. I bought it back at 85. Since it was early in the contract and it wasn't company specific, I decided to give it a couple days, see if it would bounce back. Lo and behold, it did. So I bought it back at 85 and then sold it the same option, the very same option, for 310. So how did I do? Well, forget about the 410 initially that I generated when I first sold the option. Just put that aside for a moment. After that, I had an option debit of 85 and an option credit of 310. Net, that was an option credit of 225, $225 per contract. I happen to have had 7 contracts. That was over $1,500 of extra cash that I generated into my account by being prepared with this hitting a double exit strategy. Now, I'm going to move on to expiration Friday. The price of the stock is higher than the strike price. You don't want your shares sold, or you may not want your shares sold. You could roll out, buy back, let's say the August 50 and sell the September 50 call. That's rolling out. You could roll out and up, buy back the August 50 call and sell the September 55 call. All right, the calculator will help you on those numbers there. Make sure the stock still meets all your system criteria, most specifically no earnings report coming out the next month, and you will avoid assignment by buying back the option. Here's a real-life example. I had multiple contracts of ARMH, but we're going to use one contract increments. I bought the stock at 32.10. STO sell to open the out-of-the-money 33 call for 80 cents. That means I generated 2.5% initial option return. Now, on the upper right, circled in green, you could see that on expiration Friday, price of the stock was 34.31, well above the 33 strike. Remember, I told you that even if it's a penny above, your shares will be sold on Saturday if you take no action. All right, so let's first talk about how I did on this trade, then we'll move on to rolling. I made $80 on the option sale and another $90 on share appreciation from 32.10 up to the 33 strike. I can't count it up to 34.31 because I'm obligated to sell at 33. So I made another 2.8% on share appreciation. My total 1-month return was 5.3%. Okay, we're going to push that to the back burners now because that has nothing to do with whether or not we're going to decide to roll the option. That's money already in our account, and we're not going to consider that whatsoever in our determination as to whether or not to roll. Now, if we look at an options chain to buy back the 33 call, it costs us $1.35. Notice I'm looking in the ask column, not the bid column. $1.35. Well, that makes sense. $1.31, the strike price is in the money, 34.31 down to 33, and another 4 pennies of time value because it's expiration Friday and there's almost no time value left. So that's what it would cost us to buy back the option. Now, what if we sell the next month's same 33 call? Now we go back to the bid column and we would get 210. Should we do it? Well, let's feed it into the calculator, and the results tell us the following. We are guaranteed a 2.27% 1-month return as long as share value does not decline by more than 3.8%. In other words, the price of the stock does not decline from 34.31 to below 33 by expiration Friday. Now, if that's a trade that meets your goal, then it pays to roll the option. Now, rolling out versus rolling out and up, basically the more bullish you are on the stock in the market, then the further out of the money you roll. Okay, that's just a simple guideline. Most of the time you're just going to roll out, but if the market is extremely bullish and chart technicals are off the chart good, then you may want to roll out and up as well. The calculator will help you out a lot when it comes to making those kind of decisions. Okay, here's a real life trade I made. I'm going to go through this quickly because we only have 12 minutes left. I bought, again, had multiple contracts on this, but we're going to do one contract increments to simplify the math. I bought PRLB at 78.10, sold the out of the money 80 call at 3.30. So I sold an out of the money call. That tells you that I was bullish. My initial return was 4.2%. Now, the price of the stock went down, as you'll see in a moment on the chart, and I was able to buy it back for 45 cents, which is above the 10% guideline. And then I was able to resell that same option for $1.40. So I hit a double. I sold the option, I bought it back, and I resold the same $80 strike price. Now, as expiration Friday approached, I noticed the stock was trading above 80. Should I buy it back? Well, it turns out there was an earnings report coming out the next month, so I didn't really want to use that stock. So I took no action and allowed those shares to be sold. So how did I do? Well, I sold the original for $1.90, $190, right? And then I generated 190 rather on the sale of the stock, 78.10 to 80. So let's take a look now at all the profit I made on this trade. 330, sale of the original option. 95, hitting a double, 140 minus 45. 190, share appreciation, 78.10 up to the 80 strike. Total profit, $615 per contract, which represented a 7.9% 1-month return. In this 1-year chart, in that yellow shaded area, you could see when I entered the trade, number 1. When I hit a double, see number 2, the left arrow shows the price decline and then the price recovery, hitting a double. And number 3, I made my expiration Friday decision to allow assignment. You don't have to call your broker and say, let it go. If the price is higher than the strike, your shares will be sold the next day. Here's a 1-month chart so you can get a closer look. The left arrow is where I sold the original option. The middle 2 arrows is where I hit a double when the price declined and went back up. And then I allowed assignment at the 4th arrow on the top right side of the screen. Here are the principles I used with that trade. Stock selection based on the 3 screens, fundamental, technical, common sense. Option selection based on market assessment, I was bullish. Exit strategy execution, I used the 20%, 10% guideline. And expiration Friday decision, common sense principle of avoiding earnings reports. That kind of ties everything together that we've discussed in this webinar so far. Now, many of you may have heard about a lot of different strategies related to covered call writing. Some people feel that selling cash secured puts is exactly the same. It is not. It's similar. It's also the topic of my 5th book. You could buy puts in addition to covered call writing. That's called the collar strategy. And one strategy that's very popular is portfolio overwriting, which is using covered calls in long-term buy and hold portfolios where perhaps you have shares at a very low cost basis. They're not in sheltered accounts, and you may want to, you don't want your shares sold. There's a specific way of using covered call writing in those scenarios. It's discussed in my material. You can also use a combination of put selling and covered call writing, which is also in that 5th book I discussed with you before. Okay, here is I'm going to give you a promo code for those of you who want our best and most popular and comprehensive package on our website, which is the Complete Encyclopedia for Covered Call Writing. That's been the #1 seller on covered call writing now for the last 4 years. And our latest DVD program, which is 4 DVDs, 3 live film seminars, plus an intro DVD, and the workbook, which contains all of the charts, graphs, and slides that I used in those presentations. They're all in color, plus a month of membership for free, which you can activate at any time. You could see that on our website, the package is $419. In a moment, I'm going to give you a promo code where you're going to get a $50 discount on that package. And here we go. If you go to the bluecollarinvestor.com in the store link, when you enter the promo code WINVESTING50, you will get a $50 discount at checkout, and we are also currently shipping for free. Now, let me spend the last couple of minutes telling you about free resources. Again, you go to the website, you can see it at the bottom of the screenshot, thebluecollarinvestor.com. Let me go through all the resources that we give away for free. #1 is a glossary that I wrote for covered call writing. It has all the terms that you may use relating to this strategy. You may want to bookmark that. #2 is this is the link where you can get the calculator. It says free resources, including the Ellman calculator. Now, what you do is click on that, put in your email address, and it will give you access not only to the calculator, but I wrote a user guide that explains all the tabs on the calculator and all the files that we talked about. The banned stocks, there are broker files. There's also a put calculator for those of you who are into put selling. There are a lot of free resources just using that link. #3, there are some additional videos called Ask Alan videos. Now, over the years, I've been getting email questions from members, many of them with just outstanding questions. And I started answering them in video format. I created a little mini PowerPoint, and I would put it up on YouTube and on the website, and it became incredibly popular. So what we've done is we have up on the website, Ask Alan videos, 10 selected Ask Alan videos, and the most recent one, so for a total of 11. If you're a member, you have access to the entire library of Ask Alan videos, which is, I think, about 113 now. But they're very good in terms of specific questions that you, our members, have asked about, and I was able to answer them in 5 to 10 minute video PowerPoint sessions. #4, there are additional training videos there, in addition to the Ask Alan videos. #5 is the store, where you can access all the books and DVDs, and again, that's where you would click on the link for the package and put in the promo code. And #6 now is a Beginner's Corner series. Those are tutorials for both covered call writing and selling puts. Just click on either of those links, put in your email address, and you'll have access to the 8-part video tutorials. They're 2 different series, and they're both free. And you can download PowerPoints from both of them. They have their popularity on our website is just amazing, second only to the calculator. My webmaster tells me that we have had members from 89 countries outside the United States that have taken these courses. And that's why you could see below that our website is available in 80 different languages. So thanks to everybody out there for making this such a popular resource. So those are the free resources. Just go to www.thebluecollarinvestor.com, and those are available to anybody and everybody for free. One final resource I want to tell you about, and that's our weekly newsletter. Every week I spend hours writing an article on covered call writing, put selling, or related to those 2 strategies. I put a lot of time and effort into it, and we send it out to a very large membership every Sunday morning, 10 a.m. Eastern Time, delivered to your email box. So if you'd like to be part of our free newsletter mailing list, go to the blog page, and you can see on the left side here of our blog page, you can see an Ask Alan video, and some of the articles here. Just fill in this box, which is yellow on your screenshot, but it's not on the website. Just put in your name and email and put subscribe, and then it'll ask you to confirm. And then you'll be part of our mailing list. And actually, if you go there today, you'll start getting the newsletter this coming Sunday. So there we have it. It looks like I'm pretty much out of time. Maybe have another minute or two if there are any questions that Barry hasn't answered. Robin, Barry, anybody have any ideas for me on that?
Yeah, it looks like you have about 3 minutes, Alan, so if anyone does have any more questions, feel free to ask.
Let me just add one thing if there are no other questions here, because there's a strategy now that's become incredibly popular that I've been getting tons and tons of questions on, and that's how to incorporate both strategies into one, particularly when we have market situations like we have now with situations in China, the Fed watch, and other global economic concerns. We can actually, and this is for folks that already pretty much mastered covered call writing, they want to integrate put selling, you can actually buy an out-of-the-money cash-secured puts to give you more protection. The way it works is, let's say a stock is trading at 75. You're worried that it's going to go down because the market has been so volatile. You could sell a 72.50 put for $2, and that means that you won't buy those shares unless the price of the stock drops below 70 or 72.50. With the $2 put premium, that means your cost basis is 70.50. Now, if that happens, then you could then write a covered call on those newly acquired shares. So you have downside protection from writing an out-of-the-money put, and then you could sell an in-the-money call and get even additional downside protection. So one of the beauties of these option selling strategies, once again, in my view, geared to retail investors, is you could tailor that strategy to all market conditions. Now, if the market was very bullish, market was going up, chart technicals are going up, then I would simply use covered call writing and sell out of the money strikes. So based on your overall market assessment and chart technicals, you could actually tailor this strategy to be either a bullish strategy, a neutral strategy, or a bearish strategy. Don't let anybody tell you that covered call writing is restricted only to neutral markets. That's just simply not true. Anything else out there? Okay, well, if that's the case, then let me thank Robin again and winvesting.com for inviting me to attend this webinar series, and of course to everybody out there in the room for taking the time. I answer all my emails, so if you have any questions afterwards, you could write to me, Alan, A-L-A-N, at thebluecollarinvestor.com, or you could write to Barry, B-A-R-R-Y, at thebluecollarinvestor.com, and you will hear back from us. Thanks very much, everybody. Have a great day.